In this episode, I want to talk about risk parity funds, what their purpose is, their mechanics, and the question that comes up with risk parity funds is what is the purpose of discretionary asset managers? What is the purpose of Orange Capital Partners if risk parity funds exist? I want to answer this question, and the answer is that we, discretionary fund managers, have a mandate to generate wealth by investing in disruptive technologies. And by definition, that is something risk parity funds cannot do. And also, they cannot adjust their cost structure to be able to generate wealth with disruptive innovation. That is one of the key advantages that we have at Orange Capital Partners relative to algo traders or risk parity funds. This is another In Wrong podcast. It's March 2nd, 2021. This is Crimdelco. For the day, the fund is down 4.5%. The market is down 70 basis points. For the year, we are now flat, and the market is up 3.9%. We're underperforming by 3.9%. I want to raise the question of risk parity funds. What are they? And then how do they relate to us discretionary wealth generators? And do we have a purpose? And how can we compete with them? So risk parity funds are funds that have a mandate to look at risk return profiles of existing strategies, for example, hedge funds, relative value hedge funds, risk arb, long short, things like that, tech, you name it, all the possible strategies out there. Risk parity funds look at them, then they decompose the risk return profile into factors, so basic factors, and then they reassemble based on those factors. They reassemble the profile and create synthetic vehicles that give you the same risk return but for much lower cost. This is the key idea of risk parity funds. It might be a very good idea. It works extremely well. It has created enormous amounts of wealth for the investment industry and also for the people that have invested in those funds. For example, if you want to, let's say you want to invest in chicken prices. So you want to be long chicken prices, but there is no such thing as a chicken future. So how could you replicate the chicken price with other factors? And the risk parity fund would say, well, you can look at corn and soy prices. You can look at land prices in the Midwest. Those are the key factors that go into pricing of chicken. And then you can look at a certain volatility that those factors have, and then the volatility of chicken prices. And then you can say, well, they're related in a certain way. So I can replicate, I can decompose the chicken price into all these factors, soy, land price, corn, and then I can reassemble it in a way that it reflects as close as possible the chicken price. Now, imagine using this for other things like equities, tech equities, for Brazilian equities, for Asian equities. You can use it not just for stocks, but also for projects. You can look at a company as an accumulation of projects. You can say, for example, Tesla is 3 projects. One is making a battery, second is making a self-driving car, and third is manufacturing an electric car at scale. And those 3 projects have certain risks, and those risks can be decomposed. And what these funds usually do, just to finish that, I don't want to get too technical here, but they usually end up with a conclusion that most risks and rewards in the financial markets are a combination of the risk-free rate, so the treasury, interest rate, and a bunch of equity optionality attached to the interest rate. So this is also based on Black-Scholes and Merton and the idea of pricing equity options based on pricing corporate bonds based on the idea that a corporate bond is nothing but a treasury bond with a put option attached, and therefore that's how they priced the put option using stochastic calculus, and that was the beginning of the Black-Scholes model being used in the options market. So this is just a continuation of this idea that pretty much any project in the world can be decomposed into treasury and stochastic volatility, which then gets priced into options. And therefore, you can decompose almost any risk and then reassemble it to your liking, and then offer very cheap products, cheap in a sense that low commission and high liquidity products. So you have very little bid-ask spread and very low commissions, and that allows you to get exposure to things like Brazilian equities, Argentinian cornfields, I don't know, anything you want. So this is the idea of risk parity funds. Just as a small side note here, apparently those types of funds they had some problems in the last couple of weeks, and they were off. It looks like they were part of the reason why we had this turmoil in the treasury market. I don't, I cannot discuss this in more detail because I just don't have the information. But I would say that this is very possible, and this is a good segue into why I think these funds are good, and also where the limits are of these funds. These funds are very good at giving you exposure to anything which is knowable and priced in the market. So if that's what you want to invest in, if you want to invest in projects, stocks, companies, ideas, anything along those lines, which is already priced in the market, which is available, the data to price these types of things is available in the market. If that's your goal, you should go with risk parity funds, no questions asked. And this is exactly where the limit is. Anything knowable, anything available, any information available in the market is priced in risk parity. However, we at Orange Capital Partners, our mandate is to invest in fundamentally new concept and engineering practices, and those are things which by definition are not priced in the market. And this is why we have a purpose, this is why we have an edge, because we invest in things that where the information and the know-how is being gathered outside of the realm of the marketplace. So, for example, we met Rodolphe Barangu, a very interesting person in the CRISPR community. That was an interesting meeting which gave us some food of thought on how CRISPR works and how that could be priced into the marketplace. This is something that the financial markets cannot price. They cannot price the character of one person or the comments of one person and price that. That's not how financial markets work. Financial markets, they work with correlation, with variance, with things like that based on interest rates and things like macro data and all these kinds of things. They cannot go into the nitty-gritty of understanding, for example, when a technology is ready to leave academia and become an engineering practice. Those are things which are still more bespoke type projects. They're more, I would say, artisanal in nature, and therefore require human touch, human judgment, human intuition to be able to grasp them. And this is where we come in. This is our expertise over the almost 2 decades now that we've been in this business. We have developed an ability to judge projects along those lines and invest in fundamentally new concepts and engineering practices with large impact. The second important reason that I think risk parity funds cannot compete with, particularly with funds like ours that are investing in disruptive technologies, is they don't have the cost structure. In order to make money with disruptive technology, you have to adjust your cost structure. Disruptive technologies, by definition, have a cost structure that is such that for a long time you might not make any money, and then you make a lot of money. This is exactly what happened with Tesla, for example. So you have to have a cost structure that allows for that kind of flexibility. And very often investors underestimate that it is very important that you have the right cost structure in place when you want to generate wealth with, let's say, entrepreneurial companies. Because entrepreneurial companies, for example, they do sleep on the floor, they do eat pizzas all day and things like that. But investors that invest in them, they drive around in limos, they live in expensive houses. Even in Silicon Valley, that is a problem. And therefore, I think there's a misalignment very often, and this misalignment is very dangerous. So we at Orange Capital Partners have embraced that. I think the cost structure allows our portfolio companies to disrupt incumbents, and the same way that they have to have the right cost structure to compete in the marketplace, we have to have the right cost structure to reflect them. We cannot have a different cost structure. This is a very important topic that I think is not discussed enough in the finance literature, that the investors have to be in line with the portfolio company. So if you have a wasteful company, then you as an investor, you can be wasteful. If you invest in a frugal company, you as an investor, you have to be frugal also. You cannot be wasteful and invest in a frugal company. This misalignment over time will lead to conflicts that, in my view, are very difficult to overcome. So the two main reasons why we at Orange Capital Partners believe that we can compete with risk parity funds is, number one, we are able to grasp fundamental new concepts and engineering practices better than than basically artificial intelligence, because that's really what risk parity funds are. They're using statistical models and maybe early stage AI, and in the future they will use more sophisticated AI. But in the end, they'll use the same thing like everybody else, which is data available in the market, and then they'll find statistical correlations in that data, and that's how they're going to make decisions. We at Orange Capital Partners do it differently. We look for things that are not actually priced in the market. In fact, we try to avoid things that are priced in the market, and we try to attack things which are not priced in the market, which require more bespoke approaches, more human judgment, more free will type things, more David Deutschian, better ideas replace existing ideas, that kind of thing, which is very difficult to do with AI, at least at this stage. Our principal stack, the 4 books, 0 to 1, The Innovator's Dilemma, The Innovation Stack, and The Beginning of Infinity, all are based on, like The Beginning of Infinity as a base of our principal stack says it, that we really have to start from somewhere and create something that doesn't exist before. This is how progress happens. This is how we at Orange Capital Partners intend to generate wealth. And this is also very in line with what Clayton Christensen said about, let's say, the return on equity and measures like that, which are really traps that prevent, that prevent investors or asset managers to participate in wealth generation, and even worse, that prevent entrepreneurs from receiving capital for the kind of wealth generation that they could be doing. Now, of course, things have changed. I think I've spoke about this recently a little bit. The value investor approach is, in my view, flawed for that particular reason. Value investors, they value assets based on short-term predictable cash flows, and when you invest in fundamentally new concepts and engineering practices, by definition, you cannot invest in short-term predictable cash flows. You have to have a different approach. So there's a flaw there. That's also consistent with the Clayton Christensen work, particularly the late work, where he was really attacking Wall Street for having the wrong KPIs, the wrong measurements that then prevented investees, meaning portfolio companies, to really generate progressive progress and growth. That to me is a very important aspect that still isn't discussed enough. This is still not discussed enough, and I just want to point this out. We at Orange Capital Partners are in a minority, I would say, in a minority in a sense that we are willing to adjust our cost structure, to adjust our expectations to a very volatile, unpredictable environment, because we believe this is how fundamentally new concepts and engineering practices actually work, and this is how you're able to generate the kind of wealth that we're looking to generate. And risk parity funds cannot do that, at least not yet. What risk parity funds will do is they will probably look at us and comparable funds like us once they have enough historical data, and they might find relationships between our let's say our fund and the returns that we have and the factors. For example, maybe San Francisco real estate is highly correlated with our fund or something like that. It is possible. Things that you've never thought about could be instrumental in generating similar risk return profiles. I don't think that any kind of AI or statistical model can grasp the amount of judgment that is necessary to make investments that we are making. But anyway, I think I could be wrong about that. We think we still have an edge against the AI. We still have an edge against risk parity fund. We have a purpose. Our purpose is to invest in fundamentally new concepts and engineering practices with large impact. This is also the base for our goal to have 15% unlevered annual compound returns, which is way higher than the marketplace gives you, way higher than risk parity funds can give you. And the base for why we think this is possible is because we have the ability to judge data that is not available in the financial market, so idiosyncratic data, and we also have the right cost structure to take advantage of these developments. Thank you.